Welcome to lecture 5. Here in this lecture I'll be explaining about depreciation. When we studied profit and loss statement, there was one line item, depreciation and amortization expenses, about which I said we would be coming back to. In this lesson I'll be explaining that. To do that, let me give you an example. Imagine that you have purchased a machine. That machine is an expense. So will that go into P&L statement? Of course it does. But the machine that you have purchased is an asset as well for the company. So will that asset go into balance sheet? Yes, it does. How is an asset recorded in P&L statement as well as in balance sheet? To explain that, let me give you an example. Suppose you have purchased an industrial shed for $10,000 for your company. In first case, you have recorded all the expenses of the shed in a single year. What happens? So, suppose you have made sales of 40,000 and you have other expenses of 30,000 and you have purchased shed for 10,000, then the profit that your company had in that particular year will be 0%. And in the next year, imagine that you have made slightly better sales of 45,000 and expense of 32,000. Next year, your company will show a profit margin of around 28%. Though the company has used the shed in the second year as well, but its expense is not being shown here, whereas all the expenses being shown in the first year and the profit margin is being shown almost zero in this year. Is that fair? Probably no. What you are supposed to do is consider how many years will you be using that shed for? Probably 10 years. Then you have to subtract that $10,000 every year from your P&L statement by dividing that 10,000 into 10 parts, that is 1,000 each. That's what we did in the second case over here. The same expenses, the same sales, shed is being considered for 10,000 for 1,000 rather than 10,000, and here our profit margin is around 22%, whereas in the second year it is around 26%. Moving further, it will be further considered those $1,000 because shed is being used all those 10 years. So this concept of subtracting a part of the whole expense of asset is called as depreciation. Also, in the balance sheet, in the second year, the value of the shed is considered as $9,000, not $10,000, because probably the shed has lost some of its values. That is, it has got depreciated. Let us come back to the example of a machine that we purchased for $500. How does it look year on year? So that machine probably might be sold for $400 in the end of the first year, and its value may further deteriorate to $300 at the end of second year, whereas at the end of third year it might further deteriorate, so on and so forth. So every year this $100 is what is called as depreciation. The asset value that goes into balance sheet is this value, that is 400, 300, 200 and so on and so forth. And at the end of the useful life, whatever value remains of that asset is called as salvage value. That is, we can sell our asset for that value in the market. Let us now get back to balance sheet and P&L statement and see how does these things look like. So you have purchased machine for $500 at the beginning of the year. depreciated by $100 and its value is $400 at the end of the first year. Coming to the P&L statement, the depreciation of $100 has happened and your P&L statement will look something like this. In the second year, this $400 will further reduce to $300 and your expense will remain more or less same and depreciation of $100 will get reflected in the P&L statement. This happens year on year till the useful life of the asset gets utilized. Now, probably you might have understood the use of depreciation with this example. Going further, I'll explain you that how depreciation can affect the P&L statement. The first way in which P&L statement gets affected by depreciation is the duration. Let me explain what I mean by that. Imagine that you have purchased that machine and considered that it would be used for 5 years. Then every year you will subtract $100 from the value of the P&L and because of that the margins will look something. Whereas imagine that you have considered that the same machine would be used for 10 years and because of that you will subtract only $50 rather than $100 from the P&L statement. In this case, that is the second case, the profit margins will look slightly healthier vis-a-vis the first case where you are subtracting $100. And remember that companies do have certain leeway in deciding the useful life of their machines. So when you are comparing two organizations for their financial analysis, you have to read footnotes and you have to ensure that the duration of depreciation that the two companies are considering are following the same rules. The same rules are being followed in both the cases. This is the first way in which depreciation affects the P&L. What's the second way? Second way is whether an expense is being considered as an OPEX or CAPEX by a particular company. So imagine that you have purchased a photocopying machine for your company. Probably you will consider that this is an instrument, a tool, not an asset. And when you do that, you will consider this expense as an OPEX and you will subtract all the expense, that is probably $500 within a single year because it is an OPEX, not a CAPEX, not an asset, it's a tool. Whereas if you consider this photocopying machine as an asset, then you will consider this expense as a CAPEX and you will consider the useful life say of 5 years and you will subtract $100 each year over the next 5 years. So in this case the profit margin will look slightly less vis-a-vis in the second case where you have considered it as a CAPEX, and profit margin will slightly look better because only $100 is being subtracted from P&L. This also has to be considered while you are comparing two companies. There is a third way in which depreciation affects the P&L statement, and that is there are two ways in which depreciation is considered. First is straight line depreciation, that is every year same value is subtracted from the P&L statement. Whereas in the double declining balance depreciation, a fixed percentage of the value is subtracted. That is, you have purchased the machine for $100 and you are subtracting 20% of that at the end of the year. So the machine got depreciated by $100 and again 20% of 400 would be 80 and again 20% of 320 would be 64, so on and so forth. So in this particular case, higher depreciation will be faced by the company in the beginning years, whereas lesser depreciation will be faced by it during the subsequent years. So if a company is using double declining balance depreciation, then older companies will have lesser expense towards depreciation, and because of that they'll have better profit margins when their asset investment is far away. Thank you.